Hello, this is the 28th episode of What Would Peter Lynch Do, which explores the wisdom of legendary investor Peter Lynch. Welcome to the deep dive. Today we're tackling a really great question that came in from one of our listeners. They asked, I heard about disparity when evaluating stock prices. The disparity gap is big. You should buy stocks. What is the disparity gap? That is a fantastic question. And, for anyone new to investing, disparity might sound a bit complex, but honestly, it's one of those concepts that once it clicks, it can be a real aha moment. It can shift your whole perspective. Okay, let's unpack this.
Absolutely. It's a fundamental idea, really. And our mission today is basically to make it clear for you. We'll use, simple terms, some real-world analogies, U.S. examples specifically, to give you a solid grasp of what disparity means, and crucially, how it connects to investors like the great Peter Lynch himself. But that does raise a key question. I mean, how do we define disparity in a way that really makes sense, especially if you're just starting out?
Yeah, good point. So at its very core, disparity is basically just the difference, right? The difference between what a company is truly worth and what its price tag is on the stock market right now. It's market price. Seems simple, but wow, the implications are huge for investing.
Exactly. And that true value we mentioned, that's what experts call intrinsic value. It's what the company is actually worth based on things like, well, how much money it's likely to make in the future, what assets it owns, how strong its position is against competitors. Think of it like its fundamental worth, almost its fair price, you could say. Experts calculate this using various methods, looking ahead at earning power. Now, contrast that with the stock price. That's just the price shares are trading at today, right now, on places like the NYSE or NASDAQ. And those prices, they bounce around all the time. Market mood, news headlines, simple supply and demand, lots of things push them up and down. Now, analysts have a formula. Disparity equals stock price minus intrinsic value divided by intrinsic value times 100% gives you a percentage. But for our purposes, the key thing to grasp is the concept. The market price doesn't always match the real value, especially in the short term.
Okay, let's make that concrete. Imagine a made-up U.S. tech company. Let's call it Tech Giant Inc. Say the experts figure its intrinsic value, its true worth, is $100 a share. But right now, it's trading on the market at only $80. Using that formula, the disparity is negative 20%. It's undervalued, right? The market's not seeing its full $100 worth. But what if the stock price jumped to $120 while the intrinsic value stayed at $100?
Then the disparity flips. It becomes positive 20%. Now it's overvalued compared to its fundamentals.
So negative means potentially cheap, positive means potentially expensive. Got it.
Exactly. That's the basic idea. Now let's tackle that listener's specific situation. What happens to disparity when a company's doing well, sales are up, profits are growing, but its stock price is actually falling?
Right, that's the really interesting part. It seemed totally backward, doesn't it? How does disparity explain that?
It's a great question, and it happens more often than you might think. Let's break it down. Okay, first, if sales and profits are rising, the company is clearly doing well. It's making more money, its business is getting stronger, and that logically increases its intrinsic value. The company itself is becoming more valuable fundamentally, like adding value to your house,
Okay, makes sense. Company getting better equals higher true value.
Right. But second, the stock price is falling. Why? Well, maybe the market isn't recognizing that improvement. It could be general worries about the economy, perhaps, or maybe investors are just feeling negative about that whole sector right now. Let's imagine a company, Innovate Solutions Corp. Sales are booming, profits are great because of a new product, its intrinsic value is clearly rising, but its stock price tanks because, say, everyone's worried about interest rates hitting tech stocks in general. It gets dragged down with the sector.
So the company's fine, but the market's got the jitters about something else.
Precisely. And when you have those two things happening together, the intrinsic value going up and the stock price going down, what happens to the gap between them?
It gets wider.
Exactly. The gap widens. The disparity increases. Or, more accurately, the absolute value of the negative disparity gets larger. So, in simple terms, the company's getting better, but the stock market's actually valuing it less at that moment. The price is moving further away from its improving true worth.
So it's about spotting that disconnect, seeing that the market's reaction might be temporary or just wrong based on the company's actual health. I've heard investors use this kind of cool metaphor about an alligator opening its mouth. What's that about?
Yes, the alligator metaphor. It's a classic, and it fits perfectly here.
Okay.
Imagine an alligator opening its mouth really wide. That represents a large disparity, a big growing gap between the intrinsic value and the stock price. Now, the core belief for value investors, folks like Warren Buffett, Peter Lynch, it's that eventually the market wakes up. A company's true value will be reflected in its stock price sooner or later. It might take time, but it usually corrects.
Okay.
So when that disparity is large, when the alligator's mouth is wide open, that's seen as a buying opportunity. You buy, expecting the stock price to eventually rise and catch up to the intrinsic value.
And when it does catch up,
That's the alligator closing its mouth. The gap narrows as the stock price moves closer to its true value. That's the reward for your patience.
okay, let's use a U.S. example. Golden Loaf Bakery in New York. Fictional, of course. Their bread is amazing, sales are up, profits are growing, new stores opening. Their intrinsic value is clearly rising. Solid business.
Sounds delicious. And successful.
Right, but then suddenly there's a huge well-being craze. Everyone's suddenly scared of carbs, let's say. So even though Golden Loaf is doing great, its stock price starts to fall because investors worry about the whole bakery sector.
Ah, the external factor again.
Exactly. So now you have rising intrinsic value and falling stock price. The disparity gets big. The alligator's mouth is wide open. Now, along comes a smart investor, Sarah. She looks past the craze, sees the bakery is still fundamentally strong, and thinks, wow, this stock is cheap compared to how well they're actually doing.
She sees the opportunity.
She buys the stock. And then, maybe a few months later, people realize they still love good bread. The craze fades. The market recognizes Golden Loaf's true value. The stock price starts to climb back up towards its intrinsic value.
And the alligator closes its mouth. Sarah's patience paid off.
Perfect illustration.
Yeah. It really captures that value investing mindset, the kind Peter Lynch championed. Now, disparity is powerful, but like we hinted, it's not the only thing to look at. It's especially useful in certain scenarios, like value investing itself. You're looking for strong companies whose prices are low because of, say, short-term market fear or just a sluggish market overall. Think of a solid company. Foodie Corp makes billions consistently, but its stock dips just because interest rates are high and affecting everything. A big negative disparity there could signal a bargain on a blue-chip stock.
Right, a big, stable company just caught in the crossfire.
Exactly. It's also useful for ETFs, exchange-traded funds. You can compare the ETF's market price to its net asset value, its NAV, what the underlying assets are actually worth. Usually for big ETFs like the SPDR S&P 500, ticker SPY, the price tracks the NAV very closely, almost zero disparity.
Right.
But if you saw SPY suddenly trading 1% above its NAV, that disparity might tell you to wait. It's slightly overpriced at that moment. It's more common with less traded or foreign ETFs, though.
Okay, and specific events, too.
Yeah, specific events, like a surprisingly good earnings news or landing a huge contract. Sometimes the stock price doesn't react immediately. That creates a temporary disparity as the intrinsic value just jumped up, but the market hasn't fully priced it in yet.
But you mentioned it's not the only factor. What are the big warnings, the caveats?
Crucial point. First, estimating intrinsic value. It's not an exact science. Different experts can come up with different numbers. It's an estimate.
Right, it's subjective to some degree.
Second, disparity analysis tends to work better for value stocks, those stable, established companies, than for high-flying growth stocks. Growth stocks are often priced high based on future hopes, so traditional disparity might always look large or positive.
Okay, different tools for different types of stocks.
Also, individual investors like us, we often have less information than the big institutional players. That's information asymmetry. They might know something we don't.
And the biggest one?
The biggest one. A large disparity does not automatically mean the stock price will go up. It could be signaling real underlying problems with the company that the market is seeing correctly.
So just buying based on a big gap is risky. It could be a trap.
Very risky. You need to dig deeper. Disparity is a starting point, not the finish line.
Okay, so if disparity is just one piece, like that warning light you mentioned, what else do we need? What helps us figure out if the company is actually good, not just potentially cheap?
Excellent question. You need other indicators to understand why the disparity exists and if the company itself is sound. They give you confidence. First up is PER, the price-to-earnings ratio. Basically, how does the stock price compare to the company's profit per share? A low PER, especially compared to its history or its competitors, often hints the stock might be undervalued relative to its earnings power. Imagine Starbucks. If its price drops and its PER becomes much lower than usual and you see a widening disparity, that's like a big flashing sign saying, hey, look closer.
Okay, low PER plus disparity equals interesting.
Okay.
What else?
Next is PBR, the price-to-book ratio. This compares the stock price to the company's net assets, its book value. Basically, what's left if you sold everything off, if The PBR is less than 1. That means the stock price is actually lower than the value of the company's assets per share. That's usually a sign of being seriously cheap.
Wow, like buying a dollar for less than a dollar.
Kind of. So if you see a big negative disparity and a PBR below 1, like maybe Bank of America at certain times, it could signal a very inexpensive, possibly stable stock.
Got it. PER, PBR, that's the third one.
The third key one is ROE, return on equity. This tells you how well the company uses the money shareholders invested to generate profit. It's a measure of profitability and efficiency. A high ROE suggests a well-run company that's great at making money from its investments. So picture this. A large negative disparity, meaning the stock looks cheap, combined with a high ROE. Think Microsoft, which often has a strong ROE. If its stock dipped temporarily, that combo suggests a fantastic, profitable company that's just undervalued right now.
Okay, that makes a lot of sense. So disparity is the, hey, this might be cheap signal. And then PER, PBR, and ROE are like your friends saying, yeah, and it's actually a good company, so maybe grab that opportunity.
That's a perfect analogy. They work together to give you a much fuller picture than disparity alone. It's about confirming the cheap stock is also a good stock.
It really does sound more like detective work than magic, looking for those clues. But I can hear some listeners thinking, especially beginners, okay, PER, PBR, ROE. This sounds complicated. I've never studied economics. Where do I even find these numbers? And what's a good number anyway?
Totally understandable reaction. But honestly, it's much easier than it sounds these days. You don't need an economics degree, truly. Finding them is simple. Forget needing expensive terminals. Just use free online tools. For beginners, I'd really recommend Google Finance. It's clean and easy. Just type in the company's US ticker symbol, like AAPL for Apple, MSFT for Microsoft. Google Finance shows you the key stats like PER, PBR, right there. No calculation needed.
Okay, so the data's out there. Google Finance, Yahoo Finance.
Yahoo Finance is great too, often has a bit more detail. But start simple. Now, as for what the numbers mean, you're right, there's no single magic number. A good PER for a tech company might look terrible for a utility company.
Because they have different growth rates and business models?
Exactly. It also changes depending on the economy, interest rates. So the key isn't finding the right number, it's comparison.
Okay, comparison. So how does a beginner start comparing? Give us some simple tips.
Right. Tip 1. Your main principle is compare the company's current numbers to its own past. Is its PER lower now than its average over the last 5 years? Google Finance often shows historical data.
Okay, compare to its own history.
Tip 2. Compare it to its direct competitors. How does Coca-Cola's PBR look next to PepsiCo's? This gives you industry context.
Compare to rivals. Makes sense.
Tip 3. Just practice. Pick 2 or 3 famous U.S. companies you know, Apple, Microsoft, Coke, whatever. Go to Google Finance, find their PER, PBR, ROE. Don't try to judge yet. Just look. Get familiar. Be curious. Why is Apple's number different from Microsoft's?
Just observe and wonder.
Exactly. Tip 4. Look for news. If a stock price dropped, search for news around that time. Was there an earnings report? Bad industry news. It adds context to the numbers.
Connect the numbers to the story.
And finally, for disparity itself, look at stock charts. If you read analyst reports saying the fair value is going up, but the chart shows the actual stock price going down, that visual gap is disparity. You're seeing it happen.
Great tips. So it's about observing, comparing, and connecting the dots over time.
Precisely. And remember, investing is a marathon. Don't expect to get it all overnight. Just stay curious, keep observing, and your intuition will build. Those numbers that seem abstract now, they'll start to feel more meaningful. You'll start to get that gut feeling Peter Lynch talked about, backed by the data.
Which brings us perfectly back to Peter Lynch himself. We've talked a lot about disparity, how it works, how to use it. How did this idea fit into his way of thinking?
Peter Lynch. It fits perfectly. While he might not have used the exact term disparity all the time, his entire philosophy revolved around this very concept. It was central to his success. He famously said, and this is key, the disparity between a company's success and a stock's success is the key factor that makes money.
Wow, that's pretty direct. Company success versus stock success.
Exactly. He meant the gap between how well the business is actually doing its intrinsic value, its growth, its profits, and how the stock market is pricing it at any given moment. He knew that sometimes a great company's stock price could lag behind its actual performance for months, even years. That widening gap, that disparity, that was his opportunity.
So he looked for companies doing well where the stock price hadn't caught up yet.
Precisely. He saw that temporary disconnect. Think about his other famous quotes. It's common for a company's performance and its stock price to move in different directions for months, even years. However, in the long run, a company's performance and its stock price always go hand in hand.
That directly explains the opportunity and the eventual closing of the alligator's mouth.
Absolutely. And his advice: patience pays off. And holding the stock of a successful company also pays off. That's telling you. Buy when the disparity is wide, stock cheap relative to value, then wait for the market to recognize the company's success. Wait for the alligator to close?
It all connects.
It does. And remember, behind every stock is a company. Find out what the company is doing. That's pure intrinsic value assessment. Understanding the business is how you spot the disparity, and asking yourself, can you give a plausible reason why you own a particular stock? That forces you to understand why it might be undervalued, why that disparity exists, before you jump in.
And didn't he use the PEG ratio quite a lot?
Yeah.
Price earnings to growth. That seems related to looking at value relative to growth potential.
Yes, exactly. The PEG ratio was his way of finding companies that were reasonably priced given their growth prospects. It's another way of assessing intrinsic value and spotting situations where the market might be underappreciating future growth, creating that disparity.
So Peter Lynch's whole approach was fundamentally about finding those gaps.
Absolutely. His core message really was that a truly great company's value will eventually shine through in its stock price. So, your job as an investor is to find those great companies when the market is temporarily undervaluing them, when disparity has opened up that opportunity to buy them, and then patiently wait for your reward. It's profound, really. It's not just about stocks, it's a life lesson about recognizing true worth and having patience.
That's a great summary. So for you, our listener, the big takeaway is that understanding disparity, that gap between what a company's really worth and its current stock price, it's a really powerful lens. It's a tool Peter Lynch used masterfully to find amazing investment opportunities. It's all about spotting when that alligator has opened its mouth wide, finding a strong company the market isn't appreciating, and then having the conviction and patience to wait for the market to catch on, for the alligator to close.
Couldn't have said it better myself. And maybe a final thought to leave you with. Consider a company you know well, maybe one you interact with daily, that seems stable and profitable. If its stock price suddenly dropped for no apparent reason related to the business itself, creating a large disparity, how might you use this concept and Peter Lynch's wisdom to decide if it's a genuine opportunity or maybe something else? How deep would you dig?
See you next time. This was What Would Peter Lynch Do? Thank you for joining us today. Have a nice day.